Welcome back to the What Happens Next podcast. In this episode number 47, we interview David Forsdyke and we talk about why equity release or lifetime mortgages might be an integral part of your financial plan when you're thinking about what happens next. Because for a lot of people, the money locked up in their homes, it's not right for everybody, but the money locked up in their homes is an important part of the puzzle to make sure that they never worry about money again. And it's one, in my experience, that's often ignored by people who haven't thought about building this plan. David Forsdyke, our guest for this episode, talks about financial well-being in the concept of simply meaning never having to worry about money again. And he talks about the common worries that older homeowners often go through and why they might want to consider equity release or a lifetime mortgage. I really enjoyed this conversation with David, and certainly when I'm speaking to my clients about lifetime mortgages, it's certainly something that I always refer back to. So hopefully you enjoy this episode, and we'll see you on the other side. Part of the issue we've got when we're thinking about what happens next in our lives is having the self-awareness, having the introspection to be able to think about what the gaps in our well-being are. And we're doing loads of work at the minute with what happens next to build solutions that are going to help you think about well-being in a nuanced way when you're thinking about how it applies to your life. One of the first things we've built that you can use today is our What Happens Next quiz. It's free to do, takes about 5 minutes, but what it will do is give you an insight into the areas of strengths when it comes to your well-being and the areas you might want to improve. You can take the What Happens Next quiz at whathappensnext.life/quiz, and I hope it helps you in your journey to work out what happens next for you. Hello there, and welcome to this What Happens Next interview. For those who are joining us for the first time, What Happens Next is all about what to think about when you're thinking about the next stages of your life. When you're at a crossroads and you're thinking about what you might need to know and what you might need to do to make sure you're planning, preparing, getting ready for that next stage. And it was born from a conversation I had with a client who told me that actually he wanted to financially plan, and we helped and supported him with that journey. But the transition he struggled with a lot more than he thought he would. So our job as financial planners, but also as people who are really curious about this subject, is to have better conversations about the things you might want to consider when you're thinking about what happens next. What we're going to do and what we're doing to help you do that is a number of things. Firstly, we've got a quiz, and that quiz you can access for free. There's a link, there's a QR code that should be popping up on the screen now. There it is. Click on the, point your phone at the QR code, click on the link, take the quiz, because what that will do is give you a really good insight in terms of how prepared you might be in certain areas of well-being and the areas and the gaps that you might want to consider when you're thinking and planning and preparing about what happens next. The other thing you can do that will do us a massive favour, and last week we had 550 of you subscribed to the YouTube channel, is subscribe. So that really helps us to know we're on the right track, but continue to get amazing guests of high quality to give you insights that are going to be really useful. And we've got an amazing guest of high quality today, somebody I've known for many years. He's working out where that amazing guest of high quality is. It's Mr. David Forsdyke. Now, David, I want to start with roller coasters, because before we start talking about financial well-being and where lifetime mortgages sits in that journey, we started the conversation looking at your amazing background and the photos of your family with all the roller coasters you've been on. So the
Yeah.
question on what I want to ask you first, what's the best roller coaster you've ever been on?
Oh, by far and away, it's the Nemesis in Alton Towers. That is my
Brilliant.
absolute all-time favourite. It's going through a bit of a rebuild because it's got a little bit old, and I believe they're kind of relaunching it this year. But I absolutely love the Nemesis. Closely followed by the Nemesis Inferno at Thorpe Park. They're both just fabulous. Love it.
Amazing. Amazing. Great stuff. And I know we started with favourite roller coasters, but now we've covered off that. Tell us a bit about you.
Yes. Well, yes. Thank you first of all for having me, Chris. And to support your little intro there, I have subscribed. I have done the quiz. I thought it was really
Thank you, mate.
uh, quite useful, actually.
What
A good
insight did
way
it give
to.
you, just out of curiosity? How
Um,
did you find it useful?
I think the thing that really struck home with me is that it brings into um, focus the fact that planning for the future, planning for your retirement, and so on is not just about the finances. It's about your own well-being, your own health, your own um, activities. Yeah,
Yeah,
there's so much to think about, and you shouldn't think about them necessarily in isolation. You should think about them together.
it's part of a
Um,
puzzle, isn't it? It's part
yeah,
of
yeah,
a evolving piece. So yeah, thank you,
absolutely,
and I'm glad you did it.
absolutely.
I'm glad
Yeah.
you got value out of it.
So yes, let me introduce myself to those people that don't know who I am. I am the head of later life finance at Knight Frank Finance. I've been there for the last 5 years. They made me a partner in the business 2 years ago. I'm known as an expert in the later life world, particularly in the space of equity release products. It's something that I've focused on for the last 19 years. Um, and I have a bit of history that's worth mentioning. I spent 6 years with the regulator. I was a subject matter expert for them on the equity release rules. I've done a number of different roles for the Equity Release Council on a voluntary basis, just to support them as our trade body. And my latest claim to fame, last year I won the Market Champion of the Year at the Later Life Lending Awards. That was in November of 2023. So I am the current holder of that particular award. Why they decided to make me Market Champion, I'm not entirely sure, but I do kind of make a lot of noise, I suppose, in this space. So that's a bit
Yeah,
about me.
love that, love that. And tell us about you outside of work.
Outside of work, you can see in the background there's a drum kit. Music is massively important part of my life. I play drums with several different bands. I try and get involved in writing music, recording music, performing music. So yes, that takes up a big chunk of my life outside of work. I'm also quite a keen golfer.
Yeah,
I'm keen. I'm just not very good. Um, so that can be quite time consuming. And yeah, I've got my children are all grown up now, but I do like spending time with them and with my wife when I can.
yeah. And it's interesting because I'm sure we'll revisit this because I'm writing the chapter of the What Happens Next book at the minute, all about
Right?
community and social well-being.
Yeah.
And I spoke to a friend of mine the other day. Actually, it's one of the um, members of my extended team that's going to be responsible for editing the book. And the reason I spoke to her is because she got real community well-being from being part of a choir.
Right.
And it's a choir that goes out and does a community. And I'd imagine like just that teamwork of creating
Yeah.
music. It's not, is good for our well-being, right? How do you find
Yeah.
that?
Yeah. Well, yeah. I mean, one of the things I do as a drummer is I play for my church on a Sunday, and I help write songs with the worship pastor at our church. Got my first worship song writing credit not last year, the year before. But yeah, it's a very enjoyable way of contributing something back, I suppose. And then when I'm out playing with covers bands and so on, you know, the reason I do it is because it is about entertaining other people and
Yeah.
making a fun evening for them,
They're having a
something that
great
they'll
time.
remember.
Yeah.
They're smiling, they're dancing, they're singing along. It doesn't get any better than that, really.
Love it. Absolutely love it. So you mentioned that you're a partner at Knight Frank. Tell me
Yeah.
sort of what that involves. Tell me a little bit about Knight Frank and what they do and
Right.
how they support clients.
Right. Well, Knight Frank is enormous. I imagine a lot of people who are watching this have probably heard of Knight
Be
Frank
aware of
at
it.
some point in
Yeah.
their lives. It's an absolutely enormous property business. We are a huge, estate agency business, but we are involved in all aspects of property development, surveying, consultations. And Knight Frank Finance, where I sit, is obviously the financial services arm. We support the rest of the business with mortgage broking services primarily, but we have a number of sort of strings to our bow, different levels of expertise. My area is obviously for later life, older homeowners, but we have things like agricultural finance specialists and private banking experts and all that sort of thing.
Yeah. Yeah.
So it's a
And,
very diverse business.
and what made you decide that after your range of experience that Knight Frank was the right home for you?
Well, I didn't really decide actually. I was headhunted by them. So
But you had to decide to accept at some
well,
point.
yeah. I think, yeah, I think, I think I think what I found in Knight Frank was a culture and a business ethos that had perhaps been missing in previous roles. And I kind of wish I'd found Knight Frank sooner, if I'm honest.
Yeah.
The culture is one um, of both excellence and support, if
Yeah.
that makes sense. So that the whole business wants the whole business to be successful. So we try and help and support each other, but it's also done with with this idea of being really excellent at what we
Good.
do.
Yeah, really good.
We don't want to just deliver; we want to exceed. We want clients to come away with an experience where they say, "Yeah, that was the best that it can be."
Mm.
And I think that that just rang so true with me in terms of what I look to achieve. That, as I say, I wish I'd discovered Knight Frank many years ago, but it's been a brilliant 5 years, and I imagine I'll stay with them for quite some time to come.
Amazing. So what we're going to do is zoom out and look at
Yep,
financial well-being and what it means to you, and then
yep,
start unpicking where, firstly, we're going to talk about late life lending as a concept for those of us who might need to understand more. Hopefully I know a
right.
bit, but some of our audience might not. And then we'll look at some of the elements that we might want to consider. So talk to me about financial well-being. What is, as somebody who's worked in financial services for similar to me for decades, what does financial well-being mean to you?
Um, for me, it simply means not having to worry about the money. But what I mean by that is I don't have particularly expensive tastes. I'm not a particularly materialistic person. I don't kind of splash out on the high end of anything really. I'm very happy and comfortable with the sort of average, I suppose. But for me, I don't want to ever feel that I can't afford
Yeah,
to do the things that I want to do, or I can't afford to buy the things that I need to buy. So for me, financial well-being is just about knowing that I'm financially okay, living the lifestyle that I want to live and that I'm comfortable. Um, I hope that answers your question.
yeah, 100%. And I think you're I think sometimes the false aspirations of wealth around I need to have X number are quite damaging to our own
Yeah,
well-being, because what do we need apart from enough?
yeah,
Now,
yeah,
defining enough is a different matter, and I think that is individual because we all want to live different types of lives.
yeah,
But yeah, the not having to worry about the lack of money, I think for most
yeah,
people is absolutely right. And when you're speaking to clients and
yeah.
you talked a bit about the absence of what worry, what things worry them, what things, particularly for your older clients, create an element of stress.
Um, so a lot of older homeowners tend to worry about um, running, running out of money, not quite having enough to maintain their lifestyle, and that can be things like, just simply the cost of living.
Yeah,
We've seen that increase quite dramatically over the last 2 years, and for a lot of people who are already drawing a pension, that might put a little bit of extra pressure on their income because
yeah,
their expenditure has gone up without them really having any control over it. Um, Other things that worry older homeowners, if they've got mortgages that run into retirement. Um, I'm seeing a client later on today who is 71 and still has not a huge mortgage, but a bit of a mortgage. And
yeah,
that's obviously causing her some concern. Um, don't laugh, but children can cause a bit of stress for older people. Not that they're financially
and for
dependent
younger people,
anymore, and for younger people, but
and for
no,
middle-aged people.
yeah, but for older people who've got children and they've seen their children growing up to become middle-aged people, they can still
Yeah,
worry about them from a
yeah,
financial point of view. Um, and then I think the interesting thing that I see at Knight Frank, which is perhaps a little bit unusual, is at the more wealthy end of the scale. So those people who are financially very well off, they tend to worry about things like inheritance tax, or they might worry about school fees for their
yeah,
grandchildren, or they might worry about being able to maintain a certain lifestyle. And by a certain lifestyle, imagine somebody who's fairly wealthy with property wealth running into several million. They are going to want and likely to have a certain lifestyle that carries a certain cost.
yeah.
So those are the kind of things that you see worrying people at different kind of levels.
But it's interesting, isn't it? That definition of enough can be as wide
Yeah,
and deep as it needs to
yeah,
be for that individual circumstance. And I think the what we see in our side of the world is making any sort of judgment around how much is enough for a certain
yeah,
individual is the starting point is what they want out of their life,
yeah,
not what you want to perceive as enough, for us as professionals. But certainly that element of thinking about sort of how to take the worry away and
yeah,
remove financial stretch from our clients' lives, we both think about quite a lot. Now, for me, having clarity of plan, but for you, it's I suppose part of it is understanding that an asset that they might consider as fixed and they can't do anything about, creating
yeah,
a degree of flexibility of that with that asset.
yeah.
And that's when we come to late life lending. So talk to me a bit about, for complete beginners, what late life lending is, how it works, and what options people have when they're thinking about their property that they might own or they might have a small mortgage on, and where later life lending fits into that puzzle.
Okay, very good, very good question. Probably worth giving a very brief history lesson at this point. So, if we wind the clock back 30 years, um, if you were a homeowner above the age of 60 and you were retiring and you needed to borrow money or you needed money that was tied up in your property, um, you had a very limited range of products available to you. and those products were called equity release products. And the products that were around in the 90s, a lot of them turned out to be not particularly good value. The outcomes from those products were not ideal, and as a result, the reputation of equity release was damaged. I think a lot of people still use that phrase equity release, and with a certain amount of reservation, because there's this historical stigma that it's a little bit dodgy. In 2004, equity release became a regulated product, and that was because of the introduction of a product called a lifetime mortgage. And so the slightly dodgy, poor value products that we'd seen in the past disappeared. So I think the good news is there that the products that damaged the reputation of equity release have gone, and we now have this product called a lifetime mortgage. There is a second product that comes under that banner called a home reversion plan, but that market is also pretty much closed now. So when people talk about equity release, they're actually talking about a lifetime mortgage. It became regulated in 2004, and it has gradually evolved over the last 20 years to become an extremely flexible and very adaptable product. And it's wrapped by some regulatory rules. Some of them were entirely my fault when I was in the regulator, so I now have to live by the rules that I wrote. But they're also protected by some rules and standards set by the Equity Release Council. So that's the sort of centerpiece of later life lending. What we've seen actually in the last 5 to 10 years is the emergence of a host of other options for older homeowners. So these names may not necessarily mean anything, but we have retirement interest-only mortgages. Yeah. We have payment term lifetime mortgages. We have hybrid retirement or later life mortgage products coming from the mainstream mortgage lenders. We have mainstream mortgages where criteria has moved in favor of older borrowers because the lenders are beginning to realize this is actually a growing market. So when we talk about later life lending or later life finance, what we're actually capturing there is both the equity release product and this growing range of other mortgage and borrowing options that are available for older homeowners. And when I say older, it's actually starting now as young as age 50. So later life is probably not the right phrase to use. For a lot of people, that's midlife. For you and me, in our 50s, some of these products are available.
Dave, I'm 46.
Sorry, mate.
I've just not aged particularly well. Is the honest answer. I hope you're enjoying the interview so far. I know that when I conducted the interview, I learned loads. And I always learn loads from listening to people who have expertise in a particular area, so I can share it with you to help you with your What Happens Next journey. Now, currently, I'm writing the What Happens Next book. It's nearly done. I'm still working hard. It's due to be released in 2025. And to be on the waiting list, so you're one of the first people to get access to the book, simply visit whathappensnext.life/book. But
you know what I mean. It's about you know what I mean. It's about catering for those older homeowners who they may not have reached retirement yet, or they might be retired and they've got other things to worry about. Or they might be, in their late 70s or even 80s, and they're beginning to worry about different things. So it's a huge range of products really that come under that banner of later life.
But under that banner, ultimately, it's about accessing the equity that you've built in your property, right?
Yeah, fundamentally, it's about borrowing against your home is the bottom line. But the way in which you can borrow against your home has changed quite dramatically. Lots of different options, yeah.
And what's been the biggest change from that Wild West environment where it was unregulated in 2004 to now where it's all of these frameworks are in place? What do you
Yeah.
reckon the biggest changes?
I think the standards of advice that are given around these products has improved a hundredfold.
Mm.
The regulatory rules require us as advisors to look at a host of different things and consider lots of different um, aspects with our clients that the clients perhaps haven't thought
Wouldn't
about
have thought
themselves.
of. Yeah.
Um, so I think the standards of advice has improved. Um, Also, the Equity Release Council standards have meant that we're not just meeting the regulatory standards, we're gold plating those standards by delivering an even higher quality of advice. So it's not about just doing what the client thinks they want. It's about having a meaningful conversation with the client about what they think they want now, what they actually need now, what they might need in the future, what the future could look like, what impact is it going to have on things like their tax status, their benefits entitlement, um, their ability to do things in the future. When you're 71, you're still probably fairly healthy and active. A lot of clients I see in their early 70s still quite busy.
Yeah. Yeah.
But clients in their 80s, things are starting to slow down a little bit, and they might have some more health concerns at that point. So, have they thought in their early 70s about that process of perhaps slowing down or potential health issues?
But
Yeah,
there's I think there's a flip side to that debate as well, because in our experience of building financial plans, one of the considerations that we're certainly thinking about clients more recently is that difference between life expectancy and health span. And
yeah,
it's a conversation actually that we're having a bit more of a sort of nuanced chat about during the
yeah,
meeting. Because a lot of clients are saying, Chris, I'm 58, I might have another 15 years of fantastic health where I want to spend my money. I
yeah,
actually I want to use the wealth that I've accumulated to live the life I want,
yeah,
knowing that I might be fine at 80. It might be good at
yeah,
80, but the likelihood is my health is going to be different. But I was having a conversation with my dad this week, who's 76, and he said to me that actually his desire has changed about he loves to travel. His desire to travel abroad is reducing a bit.
yeah,
Um, but so is his health and stuff like that. And I think that difference between lifespan and health span is probably an important conversation to have, right?
yeah. Absolutely. You've hit the nail on the head there. I've got a client I'm working with at the moment who's kind of mid 70s, and is he feels he's coming to the end of that desire to kind of travel and live it up. But we had a fantastic conversation about all the wonderful trips that he and
He's
his wife
down.
have done, all the fabulous holidays they've enjoyed and experiences and memories they've created. And they've reached that point now where they don't mind slowing down
Yeah,
because they've captured all those memories and they can look back and enjoy them again.
yeah,
But yeah, his plans are shifting at that
yeah,
point. He's met that crossroads of thinking, right, I don't really want to be taking long exotic holidays. I want to just have a nice comfortable lifestyle now.
yeah, yeah.
And so yeah, it's such an important part of the overall plan.
And it's really interesting because I think when we're looking at it, we're looking at all of the pieces of the jigsaw puzzle as financial planners. But where do you
Yeah.
think later life planning fits?
Um, so for me, its applications are quite broad, but I'll give you a few kind of key points which I come across quite regularly. One is where you've got clients who are um, asset rich but cash poor. So they may have spent their lives building up wealth in their own home. They may have bought very wisely or developed property or just moved regularly throughout their lives and gradually upsized, and therefore a lot of their wealth is in their property. But perhaps perhaps their pension fund is a little disappointing, or perhaps they're not seeing the levels of income that they would like. So those asset-rich, cash-poor clients, there are ways of accessing the property wealth through lifetime mortgages that I mentioned before. You can have a drawdown facility. It's like a cash reserve that's pre-agreed, secured against your house, and you can then drip feed the funds out of that reserve. So that keeps the costs to a minimum. So that's one example of where later life finance can really make a difference, topping up someone's income, helping pick up that shortfall if they are asset rich but cash poor. Second thing, if people have mortgages or other debts that are running into retirement, that can be a real stress and a real strain on people's income, because obviously at the point they retire, there's likely to be a change in their income. So being able to perhaps consolidate their mortgage, perhaps other debts, have a bit of a tidy up, I suppose, of the liabilities. There are ways we can use later life finance products to help them with that, to make things a bit more manageable. With a lifetime mortgage, and I know I keep mentioning them, but with a lifetime mortgage, you can allow the interest that's charged to roll up on top of the mortgage if you want to. You don't have to, you can carry on paying, but a lot of people choose to allow the interest to roll up, and that removes the need to make regular payments. A lot of people find that quite attractive, especially if they've got a lot of equity in the property and only a few small debts, but they don't really want to have to be paying those debts anymore. Another example where it fits in quite nicely is where at the wealthier end of the scale, where you've got clients who are, they might be perhaps higher rate taxpayers. They might have very healthy levels of income, but some of that income might be coming from their pension funds or from their investment base. And if you're already a high rate taxpayer, as you know, when you make a withdrawal from a pension fund, you're paying 40% tax on what you take out. So for a lot of those wealthier clients, their property wealth can become a source of income, a slightly more tax efficient, potentially, source of income. Because instead of paying tax, it's not actually income, you're borrowing the money. So instead of paying income tax, you're paying interest on what you've borrowed. And it can take quite a lot of years before the interest adds up to as much as the tax would have been.
I mean, the big factor there as well, Dave, is that position where you're taking money from a pot that is excluded for the purposes of inheritance tax calculation.
Well, yeah.
And that's big. You know, you're not only paying you 40% tax, you're leaving assets at the table that are on the table that are liable for inheritance tax and taking it out of a pot that isn't. So there's a double impact there, isn't there?
That's where for me it gets really very interesting, but also very complicated.
It does.
So we do a lot of inheritance tax planning hand in hand with people like yourself, Chris. So we're not authorized to give pension and investment and tax advice, but I've had to learn enough about those things in order to
know where it
work alongside the experts and do that level of inheritance tax planning. And it is fascinating when you look at it. It feels counterintuitive to a certain extent that why would you borrow money in order to reduce an inheritance tax bill? But when you actually model it out over the long term, you begin to see the benefits, and you begin to see that you are creating more wealth for your beneficiaries than if you didn't borrow the money.
I think
that's my favorite part of the job, really, is doing those kind of modeling exercises for the clients.
I've got a story to tell you on that, but I think here's my really complete guess at why we might think like pensions. It's because we've been socialized to believe pensions are designed to pay for our retirement.
Yeah.
The language we use around pensions is all about that's the money I need to when I stop
Yeah.
work. And I think what we're trying to do on What Happens Next is have more nuanced view, like a more nuanced perspective on that retirement might not be right for you. It might mean continued work, and that industrial move from all work to stopping work might be worth reconsidering for your own well-being. But also, all pensions are effectively is a tax wrapper that you choose what to do with when you decide what happens next. And it might mean using it, but it might mean exploring other options. And on the note of exploring other options, when you were talking about sort of releasing equity from property, I've had a couple of conversations with recent clients where there's a gap in their plan that we need to at some stage fill potentially through property, but we've got other options with property. We could potentially downsize, we could potentially sell and rent, probably not something many clients want to do, but it's an option. When you think about that, pros and cons of downsizing versus lending on your existing property, what are they typically, and what factors
Yeah.
should somebody thinking about this sort of stuff consider?
Yeah, good question. The important thing there is to explore the alternatives thoroughly. I mentioned earlier that one of the things that's changed is the quality of advice that's given, and one of the things that really adds quality to that is exploring alternatives with your client.
Mm,
Um, and sometimes that means we end up recommending that they don't go ahead with any form of borrowing. They actually take a completely different course of action. But that's what good advice is about.
yeah,
So the alternatives that we look at are the obvious ones, things like downsizing. That can be an uncomfortable feeling for a lot of clients because they become very attached to their property.
yeah,
So you have to sort of take them through a process of considering the pros and cons. So yes, you love where you live, you love the location, you love the building, you're comfortable here, but if you did move to something smaller, your bills are going to be smaller, your running costs are going to be smaller. You're going to have less, kind of garden and house to look after. So the strain on you physically to maintain everything is going to be smaller. So we encourage them to think about all those kind of things. Um, we also encourage them to think about other ways of raising funds. So where they have got pension funds, investment savings, we make sure that we look at those and we talk through the pros and cons of using those funds versus borrowing against their house to make sure
yeah,
that it makes good financial sense to borrow. Um, we even talk to them about other ways of raising money. If they're a retired couple in a house, they may have a spare bedroom or two. Have they thought about renting a room out, taking on a lodger, doing a professional letting of some sort? That can bring in extra income, and that can start to take the pressure off them financially. Um,
I had a great conversation with a brand new client of mine who's the MD of a charity, and she's approaching sort of thinking about stopping work. And we were talking through a financial plan and actually talking about what happens next and what she does with her time and stuff like that. And she's got a big house in North London, does really well, and she rents 2 rooms out.
mm,
And she was telling me about sort of, I said, well, okay, how did that start? And there's a friend of mine had kids who wanted to move to London and, wanted to, and what was interesting, and I think she makes a really fair point. She went, I did it because it supplemented my income. It's like, right, okay, well, that makes
yeah,
sense. Supplements her income to the tune of about £15,000 a year, seven and
yeah,
a half thousand of which is tax free because you get a rent a room allowance, which is
yeah,
brilliant. So,
yeah,
so part of it is tax free. But the other interesting thing she said to me, Dave, when we were talking about overall well-being, is that it's massively improved her social well-being because she's not
Yeah.
going home to an empty house with no kids in. She's now in a position where she goes home, and so actually, when we're thinking about some of these options, and when we're zooming out to think about what happens next, some of these options might enhance other areas of our lives as well. Depending
Yeah.
on who you
Yeah.
are. But it's interesting how sometimes two levers can be pulled at the. I've been thinking a lot
Yeah.
about this, and I'm writing about it in the book. I'm calling it well-being stacking. What can we do to actually
That's a great phrase.
turn around and go, well, that'll improve my social well-being, but it'll also improve my financial well-being. And how can we stack those two
Mm.
bits together to actually enhance our lives? But when you talk about sort of renting rooms, that's not for everybody, and it depends on
No,
who you have
no.
renting the room. But actually, in the right circumstance, it can work really well.
Yeah, and it's an important option to explore. Like I say, we take the clients through the pros and cons of that. Um, and you've just reminded me, actually, one of the other alternatives that we talk to people about is, some of them laugh when we say this, but we talk to them about the idea of going back to work, maybe even in a reduced capacity, some kind of part-time work.
Yeah,
Um, and we'll even say that to an 80-year-old, because it's not that we're expecting them to go out and work if they don't want to, but it's interesting that a lot of them at that age want to be doing something. They want to feel that they're contributing in some way. They want to feel that there's some activity, and so yeah, that rings very true with this idea of well-being stacking. I like that phrase. Um, yeah, by
I've
going
not trademarked it yet, Dave, so don't steal it
okay.
yet.
Yeah, but yeah, if they went back to work for a few, just for a few hours a week, that might
Yeah,
that might earn them a little bit of extra money, but perhaps even more importantly, that might get them engaging with other people. It might get them a little bit more active, which is good for their health. Lots of
intellectually
different, yeah,
engaged.
yeah, lots of different aspects. So yeah, it is. Like I say, a lot of clients laugh when we say it to them, but it's an important question to ask. Would you consider going back to work, even if it was just part
Yeah,
time?
yeah, no, I completely get that. I suppose one other thing that we've had as with clients of ours, particularly when we're thinking about removing financial well-being, is that stress of having a conventional mortgage. Because we've had clients who have come in who have said, I've reached an age where my traditional lenders said I need to pay my mortgage back.
Yeah,
I thought, what are the rights? I mean, just thinking about this, what are the rights somebody's got in that space to have a conversation with their existing lender, and how would it work with transferring
yeah,
that potentially to a lifetime mortgage to remove that stress?
yeah. Well, there's an interesting thing happening at the moment. Obviously, lenders have the right to set their own
Terms.
criteria, even when it comes to age. Um, but an interesting thing is happening. A lot of lenders are now either extending their age limits or removing them completely. Um,
Interesting.
and this is really, really good news, because it allows mortgage holders to potentially continue with the same lender, or if their own lender still has an upper age limit, they can relatively easily remortgage to a new lender on a normal mortgage, but to a lender who perhaps doesn't have an age limit or doesn't have the same level of sort of maximum age. So yeah, there's an interesting shift kind of happening at the moment, and the reason for that is that lenders have realised that this older population is becoming more and more important, and more
Yeah,
people are taking a certain amount of mortgage debt into retirement. Lots of reasons that that's happening. Obviously, property's got much more expensive over the years, so we're having to borrow a bit more. We spread it out over a longer term. It naturally takes some people into retirement. So yeah, there's an interesting shift, but lenders have the right to set a limit if they want, and if you're with one of those lenders, then you may need to look at remortgaging. Um, the good news with lifetime mortgages is that they don't have any kind of affordability hurdle. You don't have to demonstrate to a lender that you've got enough income to afford the payments, because the underlying contract allows the interest to roll up. There are no sort of payments required. You can continue to make payments of the interest, some of the capital if you wish, but you don't have to. So some good news there. If you've retired, your income has shifted a bit. You can move to a lifetime mortgage without having to worry about an affordability assessment. The transition for a lot of people is reasonably straightforward, but it's important they take the time to understand what makes a lifetime mortgage different to an ordinary mortgage. There are a number of aspects that make it a bit different. And it's also coming from a different background. They're not funded by the banks or the building societies. They tend to be funded by the pension provider firms.
Yeah.
So it has a slightly different look and feel to it, but the transition is actually relatively easy.
And when people are thinking about lifetime mortgages, talk to me a bit about timeframes. So, we encourage clients to think about what happens next as early as possible so we can plan for it as soon as possible. But we also recognise the fact that often people get to a point where they ignore it and then feel the need, feel the pain to go and do something. What sort of timescale should people consider when they're thinking about, okay, I may need to take a look at this and examine this as a route?
Explore it as early as you possibly can, even if you don't need to make a decision for a year or two. Start exploring it and start understanding it and talk to an advisor. I have clients that I'm dealing with now where the conversation started over a year ago. So if it is something that's perhaps on your mind or might be on the horizon in terms of your financial planning, start the conversations early. If you're using a lifetime mortgage to perhaps repay an existing mortgage, give yourself a good 3 to 4 month window.
Yeah.
I've got two clients at the moment where there's two extremes. I've got one client whose normal mortgage actually ended last year, and they, as you were saying, they've just been putting it off and putting it off and putting it off until they reached a point where they were literally forced to do something.
Yeah.
And they came in to see me, and it was all a bit of a mad panic. And we've managed to sort them out reasonably quickly, but they felt under pressure. We felt under pressure. It was an uncomfortable process to go through. I've got another client I'm dealing with at the moment who has done it the right way. They have a mortgage that comes to an end in October. We started the conversation a couple of months ago. We've made an application for a lifetime mortgage this month, and that gives us now a 3-month window to put everything in place comfortably, and it'll roll over quite nicely for them in October.
And that first scenario is a really good example of financial stress by ignoring some of these issues, isn't it? It's like increased financial well-being because you're not tackling it sort of stuff. We've zoomed in, we've zoomed out, looked at financial well-being, we've zoomed in and looked at how lifetime mortgages play a part in that potentially, in all of the factors that they might be worth considering. I want to zoom right out now.
Okay.
Talk about well-being in the context of some of the other areas. What would be your what I think one of the best things about our job is we get the experience of just learning from loads of different people, because we see clients. I don't know about you, but I see clients every day where I go, actually, I'm going to steal that, because that's a great idea of not only how to manage money, but just how to live a life, like in terms. So talk to me about what happier life means to you and what you've learned from a conversation with a client about well-being.
Oh, wow. That's a really tricky one, because there's so many different things I could talk about. Where shall I start? So to me, well-being starts, I think, with your own attitude, with your own approach to life. So I've always tried to be very positive, very upbeat. I have a reputation for being known as quite a happy person.
Yeah.
But that comes from my own sort of attitude. I've adopted that. Said to myself many years ago, right, I need to be that happy, positive, upbeat person, because that makes me feel better. That makes people around me feel better. That makes my clients feel better. Makes the family feel better. It just brings us energy to everything. So I think your own attitude really, really important. Um, Rhyming with attitude, I think gratitude is really important as well. And I see this a lot in my clients. Older clients who seem to be happier are the ones that are extremely grateful for what they have, and they're extremely grateful for other people, doing things and helping them. And they express that gratitude quite openly and quite often. So attitude and gratitude, I think, hugely important. And it doesn't quite rhyme, but the third thing I'm going to put on this list is have a hobby, have something that you're really passionate about that absorbs your time. But it absorbs your time in a way that you're delighted by it. For me, it's music. If I'm not playing music, I'm quite often thinking about music. I'm writing music. I'm recording music. I'm fiddling around with set lists for the next. Yeah.
Is that flow state, that focus where you go, I just love this. Yeah.
Yeah. It's just about having a passion for something, because it brings joy. It brings fulfillment. It brings a level of interest. It brings a level of stimulation. Lots of really positive aspects. I mentioned golf. Golf is an all-consuming hobby. When you're out there on the golf course, you can't think about anything else, can you? You can only think about your golf game. And I think that kind of thing, that level of passion is really important.
And I know you've been sharing, because I love your LinkedIn posts, and we share a passion for optimism and enthusiasm and gratitude, and we do it in different ways. And we did it for years by talking about kindness for years. And you, thankfully, I'm grateful to your contribution to this, helping us out with your sort of just what you're grateful for that we've stolen, and we call it Wins of the Week now, and we do it every Friday on LinkedIn. But the it's an interesting one, because I know there's challenges with the tools that technology give us, and I certainly think about this with my kids, but also often the barriers it can put in place to our well-being. What are your thoughts around that, and what can we do to get those barriers right?
Okay. So I guarantee there are people who are watching this right now who have probably got their mobile phone in their hand. And
it's
they're looking.
Bit of a paradox, isn't it? Because hopefully we're sharing good stuff.
Yeah, but they might be watching this on a computer screen, but they've also got their phone in their hand because they're in the middle of a chat. My advice is put the phone down and pay attention to just one thing.
Yeah.
Because I think what's happened is modern technology has. It's going to sound terrible, but I think it's caused us all to have a mild case of ADHD. Because we're constantly distracted by lots of different things. I've got a computer screen here. I've got my mobile phone here. We're constantly looking at different things. Oh, social media is just bleep. There's another message. There's another post. Constant distractions, and that's stopping us from focusing on one thing at a time.
Yeah.
So that's where I think modern technology can be quite harmful. It's removing our ability to really focus.
To point to how damaging that is to well-being. There's evidence already. There's research already that points.
I'm guilty of it myself. I'm quite often distracted by social media and so on, and I have to stop myself. I have to say no. I need to put that away. I'll look at that later. Keep my focus where it needs to be now. And I think if we can all, again, having the right attitude. If we can all just keep our focus in one place, we will all feel a lot better.
Yeah, 100%.
Not be so easily distracted.
And again, we're all guilty of doing it, but being intentional about it is probably where we need to be.
Yeah.
Love today. Really enjoyed sharing your expertise with everybody on what happens next. Hopefully, you've watched this with intention, without checking your phone, but who knows? But what we wanted to do is share some uh, Dave's knowledge and experience. And I think the message we can really share is examine other options when it comes to your financial plan, and understand that often we've got assets that we don't appreciate might help us fill whatever gap we've got, and we should certainly consider how that fits in as part of the mix. Dave, can you just share where people can find out a little bit more about you and the work you do?
Yes, very easy to do. If you type into any web browser, whatever browser you might use, just type in David Forsdyke Knight Frank, and it'll take you to my contact details on the Knight Frank website. Or you can very easily find me in LinkedIn. Or if you just do a search for David Forsdyke Equity Release, then you'll see me appearing in various news articles and so on. So it's relatively easy to find me and to get in touch with me.
Perfect. Thank you for your time today, Matt. Really appreciated it. That's it for this episode of What Happens Next. I'm sure that you'll agree with me that David Forsdyke did a brilliant job explaining how equity release or a lifetime mortgage might fit into your life and your financial plan. Again, I'd love to hear your thoughts about this episode. Let me know what you got the most out of when you were watching this episode. Have a lovely day, and we'll see you on the channel soon.